Hello everybody, very happy to be with you today and very sorry for a couple of minutes of delay. It's a great time normally in Paris, hardly any tourists, great weather, but the traffic is always a disaster whether it's winter or summer. Thank you Andreas and thank you Florence for inviting me. It's important to be here, important to be with Insurance Europe because when I'm thinking back to my interactions with Insurance Europe through the PIFE, I was always very pleased of these interactions, and certainly in a time in which lots of things are going on, and I like a lot your topic, protecting tomorrow, because when you think about protecting tomorrow, a lot of people always think that the insurance industry doesn't have a role to play. We are often seen as a bit dusty, a bit focused on the past. But I guess when you look at the changes that are happening today, insurance has probably never been that relevant. Which means that when there is uncertainty, when there is risk around us, it's our moment. And so what I would like to do is talk about our moment and talk about also what we need to do in order to benefit from that as a whole sector. When we look back for a minute, we see that certainly a lot has changed since February 24th last year. We are seeing that geopolitics, who have been what has been in the freezer for a long time because nothing has really changed, all of a sudden everything is changing. It has certainly started with the war in Ukraine, but even if you look beyond that and look at the tensions between the US and China around the question of Taiwan, but also around the question of the economic and political competition that we see, it leaves a lot of traces in our daily life. It certainly has started with an energy crisis that we have seen and that we have also felt here in Europe. I remember very well, now it's warm outside, but when we were only allowed to heat the offices to 19 degrees, it was not always very pleasant. But we've also seen many other things. Inflation coming back. Many of you in the room are probably still too young, like me, knowing the phenomenon of inflation. We've seen currency shocks coming back and certainly also recession coming back in many countries that we would have not thought could be hit by recession. Many people think and wish that those risky and shaky phenomena will leave us tomorrow. I personally believe that unfortunately they will not leave us, and that we are confronted with a new reality that we have not seen for many, many years, but where we've probably also been a little bit naive to neglect them. And being naive and looking away has probably unfortunately created the rude wake-up call that we have seen. For us, it is very important that one element that drives our industry a lot, which is obviously interest rates. And we've been living for a long time now with low interest rates, and it's clear that the era of low interest rates is now definitely over. And this wouldn't have been an issue had the move to higher interest rates been smooth and over a long time. Unfortunately, we've seen exactly the opposite, that the increase of interest rates has probably happened in the most brutal way that we have seen over many, many years, which certainly has put us in a very different position, has created a lot of issues for us when you think about the way we have invested and the way we will invest, when you think about how appreciated or not appreciated life insurance is relative to other products. And the low interest rates were difficult for us, but it was from one perspective easy. everything was low. Now we find ourselves in a situation in which we have to defend our products that are more longer-term products and that are sometimes yielding less than, for example, the 2-year Treasury. And so we are now in a phase in which there will be a massive reshift and rebalancing of monetary funds towards a very different allocation. And in this period, obviously, financial risks are surfacing, and certainly financial naiveties and mistakes that have been made in the past will become apparent. And so we have seen some of them already, starting certainly with the turmoil that we have seen recently in the US. We've also seen states and governments suffering from those attacks. If you look back at the episode around the mini budget in the UK. And when you go forward, there is also quite some imagination where this could still happen. A lot of discussion at the moment is around corporate real estate. We have not seen any corrections yet in private debt. We have seen very little transactions in private equity. And so when the transmission of higher interest rates to the real economy really happens through the refinancing of deals and through the let's say, lower availability of financing, it is clear that this will leave traces in financial markets. What we can say is that so far there has been no systemic element, neither for banks nor for insurance companies. But I guess going forward, we need to make sure that this stays this way. Because what is interesting to see is that after the financial crisis of 2008, many risks that were in the system, in particular in the banking system, have disappeared from the banking systems, but have not disappeared as such. They are still somewhere. And when you look today that about 50% of the global assets are not in the traditionally regulated banking systems anymore, but in so-called lower or non-regulated systems, you can imagine that in those areas the vulnerabilities will certainly be higher than what we've seen in the past. I mentioned the UK and the mini budget, and this is obviously also something that personally worries me. Because when the central banks, again, after having increased interest rates, also reduce their liquidity supply in the financial markets, we will certainly see there as well that there will be less appetite that we have seen relative to 2-3 years ago for certain government bonds. We will see lower liquidity. And what has been a force so far and has given us I would say, soft landing of the many crises we have seen, be it the energy crisis, be it the COVID crisis, that deficit spending and government spending has absorbed those shocks and has given us a soft landing. I think there is probably a hypothesis that this will not continue the way we have seen it going. Because if you have less demand for government debt in the market, if you have less tolerance for higher debt in the markets, I mean, we've seen now that there was a good solution around the debt ceiling in the US, but who knows whether all the European markets that are in high debt will also be seen in the same way by financial markets that they used to be seen. And we are here in a country that has the similar challenges around a very high debt to GDP ratio and the necessity to continue structural reforms and to make sure that the discipline around budgets and fiscal budgets is important to keep. All of this is an environment that is challenging for us, that is complex for us, that is unforeseeable because every day something new pops up and every day something different happens. Nevertheless, I believe it is certainly our time now. When I look back at how often I've been asked myself around the insurance industry, what we are doing, what we can contribute, it has never been that high in terms of demand. Why is that the case? Because we have many new risks around us. We have many new questions around us where nobody has the answer, but where we can provide the answer. And one prerequisite for even being asked is the fact that our sector has so far been remarkably solid. When you look how our sector has gone well through COVID, how it has gone well through the crisis of the war in Ukraine, we should really be proud of ourselves how well we have managed that. Nevertheless, we also need to make sure that we are continuing this journey. And in this respect, when you go back at the regulation that we have in our sector, I know many people often dislike the regulatory burden, but when you look at how regulation has given all of us discipline, how it has helped us to be disciplined and sometimes boring in our balance sheet and good boring, and how it has really given us a framework of thinking of stability, I think it's important that the whole industry continues to be engaged, in particular when it comes to the evolution around regulation, be it the revision of solvency, but also be it the question now, how can our industry really contribute to the question around the climate transition. When we look at what is around us, we see an interesting phenomenon. We see that risks are increasing, and we see new risks popping up. And as AXA, we have done for over 10 years now a future risk report, where the 10 largest risks are more or less the same, but they change very much in their hierarchy and in their severity. What we also see is that at the same time, the aversion to risk in our population is growing. And so the question for us is, how can we make this equation work? If you've got more risks, less tolerance to bear the risk, and also less flexibility and absorption capacity of governments to help us managing these risks, this is nevertheless an equation that is difficult for us to solve, but we are obliged to solve it. In addition to that, when you look forward, we have several other trends that won't make the equation easier. If you think about the demographic shifts that we are having in front of us, if you think about emerging risk, and I know when we think about AI and ChatGPT, we like to talk about all the positive impacts that we can imagine for our industry. We like to talk about the regulation, but we don't often like to talk about the fact that what reinforces us in our business will also reinforce others that don't have the same intention that we have. And that's why I think it's important that we use this moment and we make sure that we use our expertise, our financial capacities to really make sure that we help companies, that we help individuals in really finding solutions for these new risks. Finding solutions for these new risks means that we need to preserve our financial strength, because if we lack underwriting discipline, if we lack financial and balance sheet management discipline, we will not be the ones that will be acting tomorrow. And therefore, keeping our discipline, but at the same time, thinking about how can we find solutions. And by solutions, I don't mean not only how can we just always apply the traditional mechanisms of covering risks. If you think about cyber, for example, the solution of covering more cyber is probably not to say how can we extend our coverages into risks that we don't even know how to model. Maybe the solution of tomorrow is much more of a bundle between insurance coverage, a service, and also a skin in the game of the company that wants to be protected against cyber. In order to get there, we also need to think about how do we get the right human capital in our industry. Because when you talk today to potential applicants for our industry, and when I, for example, talk to my young children, insurance is not the first topic that comes to their mind. And I think it's up to us to also show future talents, the next generation, that we have a real pivotal moment that we are heading towards, helping society, helping companies, helping individuals to really cover and find solutions for these new risks. And that goes on the one hand with raising awareness around these risks, but it also goes on the other hand with the question of being there not only for our customers, but also being there for society. Because with raising and more risks, there is one effect that could also be quite dangerous for us. When the cost of risk is increasing every year, you will have less and less people that can afford to insure. When the complexity of risks is increasing, we often tend to go into the way we've always done it. The easiest way to solve it is to exclude. We find ourselves more and more in a situation in which we cannot insure, cover, protect a large part of businesses and population. And this, for me, is a societal task that we all have. We don't want to find ourselves in an industry that is in quasi-runoff because we are reducing our activity more and more. We need to think beyond and say, what can we do for society? How can we invent solutions that, for example, tomorrow, somebody who has got diabetes, who is a diabetic, is not a bad risk and excluded anymore, but is seen as a good risk of somebody who's got a high awareness of his or her health and that we need to help. So, difficult environment, complex environment, it will not get easier down the road. Nevertheless, I do believe we have got a great moment ahead of us if we grasp that opportunity, get the right talents in this industry, be more creative and innovative around what an insurance solution could be, and if we also look beyond our own customers towards the whole of society. Thank you very much.